There is a specific Saturday morning that changes everything. You wake up, make your coffee, open your investment app, and for the first time in your life, the market did more work for you last week than you did at your job. Let me say that again so it lands correctly. The market grew your account by more money than you earned at work. In the same week, you didn't do anything. You didn't pick a stock. You didn't analyze anything. You just existed, went to work, did your thing, and the money made more money than you made. That is not a fantasy. That is not what happens to other people. That is a mathematical certainty that occurs at a specific calculable point in your wealth building journey. And most people have no idea that point exists, what it feels like, or how close they might actually be to it. That the point is somewhere around $300,000. And today I'm going to show you, using the actual math, the actual history, and a NASA concept that explains everything, exactly why $300,000 is the number where wealth stops being something you build and starts being something that builds itself. My name is Slime Johnson. This is Slime's Wealth Academy. And this video might be the one that finally makes the whole journey make sense. Let's go. If you're someone who has been doing everything right, investing consistently, increasing your contributions, watching the number grow, but still feels like you're the one pulling the weight instead of the math doing it for you, hit that subscribe button and give this video a thumbs up if it helps. Because today we're talking about escape velocity, the exact moment where the gravitational pull of not having enough finally breaks. The moment where your money starts making more money than you make and stays that way. We're going to walk through the math, the history, the psychology, and the exact map to get you there. So stay with me. Part 1, the history lesson, Apollo 11 and the physics of wealth. I want to take you back to July 16, 1969, Cape Canaveral, Florida. The Saturn V rocket, still the most powerful machine ever built by human hands, sits on the launch pad carrying 3 astronauts and the collective ambition of an entire civilization. The rocket weighs 6.2 million pounds. It burns 20 tons of fuel every single second at liftoff. And for the first few moments after ignition, something counterintuitive happens. It barely moves. All that power, all that fuel, all that engineering genius, and the rocket rises from the pad at almost agonizing slowness. The first mile takes longer than you'd expect from the most powerful machine on Earth, and then something changes. As the rocket burns fuel and gets lighter, as it climbs above the densest part of the atmosphere, as the forces of gravity and drag begin to weaken, the same engines that could barely lift it off the ground start accelerating it faster than any human had ever traveled. By the time it leaves Earth's atmosphere, it is moving at 17,500 miles per hour. The rocket didn't get more powerful, the resistance got smaller, the conditions changed. And suddenly the same energy that could barely move the rocket off the ground was sending it to the moon. That's escape velocity. And your investment account works on the exact same physics. Here's what most people don't realize. The reason building wealth feels so hard in the early stages isn't because you're doing it wrong. It's because you are in the densest part of the atmosphere. You are burning maximum fuel, maximum sacrifice, maximum discipline, maximum percentage of your income, and moving at what feels like agonizing slowness. But the conditions are about to change. Now, I want to give you the historical parallel that makes this concrete. Let's go to 1981. Paul Volcker, the Fed chairman that everybody hated at the time and everyone credits as a genius now, has just finished slamming the brakes on inflation by raising interest rates to 20%. 20%. The economy is in a brutal grinding recession. Unemployment is at 10.8%. The stock market has gone nowhere for over a decade in real terms. Investors who started in 1968 have been holding for 13 years and their portfolios adjusted for inflation are worth less than when they started. Those people quit in enormous numbers. The data on retirement account abandonment in the early 1980s is staggering. People who had been contributing through the 1970s stopped, cashed out, said the market doesn't work, and walked away. Here's what they walked away from. Between 1982 and 2000, starting the year after Volcker's recession, the S&P 500 delivered what historians call the greatest bull market in American history. An 18-year run that turned every $10,000 invested in 1982 into approximately $180,000 by 2000. The people who quit in 1981 didn't just miss a good market. They missed the moment their atmosphere was about to thin. They were $20,000, $30,000, $50,000 away from the escape velocity threshold. And they ejected from the rocket right before it started accelerating. That is the tragedy I'm trying to save you from. And understanding the $300,000 threshold is exactly how you avoid it. Part 2, they dated the exact math of escape velocity. Numbers time, real numbers. Because this is the part I want you to screenshot, save, send to your skeptical friend who thinks investing is for other people. Let's start with a simple assumption. You are investing in a broad market index fund. The S&P 500 has returned an average of 10.5% annually over the last 50 years. Not in a great year, not in a bad year. The 50-year average, that's the number we're working with. Now let's look at contributions. The IRS limits for 401(n)A contributions in 2024 are $23,000 per year. That's roughly the maximum most people can contribute in a single tax advantage account. But let's use a more realistic figure for a middle income household doing well, but not maxing every account. $12,000 per year, $1,000 a month. That's our benchmark contribution. Here's the math most people have never sat down and done. At $100,000 in your investment account, a 10.5% annual return generates $10,500. Your $12,000 annual contribution outpaces your investment returns by $1,400. You are still the most important engine in this equation. At $200,000, a 10.5% return generates $21,000. You contribute $12,000. Now your investment returns outpace your contributions by $9,000. Interesting. The math is shifting. At $300,000, a 10.5% return generates $31,500. You contribute $12,000. Your investment returns outpace your annual contributions by $19,500. This is the inflection point. This is where the rocket breaks through the atmosphere. At $300,000, the market is now making 2 solid and 62 for every one you contribute. The math has inverted. You are no longer the primary engine of your wealth. Compound interest is. Let's keep going. At $400,000, returns generate $42,000 against your $12,000 contribution. Returns are 3.5x your contributions. At $500,000, returns generate $52,500. Returns are 4.3x your contributions. At $750,000, returns generate $78,750. You contribute $12,000. Returns are 6.5x your contributions. Your account is growing by nearly $79,000 a year while you add $12,000. The money is doing 6.5 times more work than you are. At $1,000,000, returns generate $105,000 against $12,000 in contributions. Your money makes 8.5 times what you contribute. This is where it gets really interesting. And I want you to feel what this means practically. At $1,000, even if you stopped contributing completely, stopped adding a single dollar, your account would still grow by over $105,000 next year. That's more than the median American household earns in a full year of working. Your money is now working a full-time job. And it doesn't take sick days. It doesn't have bad weeks. It doesn't negotiate for a raise. It just compounds. But here's the subtle, crucial thing about $300,000 specifically that makes it the threshold and not $200,000 or $400,000. $300,000 is the point where your investment returns don't just exceed your contributions. They exceed them by enough to also cover a meaningful financial emergency without disrupting your compounding trajectory. At $300,000 growing at 10.5%, even a $15,000 emergency expense, a medical bill, a car, a roof, is covered by your annual returns with money left over. The math makes you structurally resilient for the first time. It's not just that wealth is building itself. It's that wealth can absorb life while building itself. That's not $200,000. That's $300,000. There's a qualitative difference and the physics of the number create it. Part 3, the villain. Why most people never get there. Here's the part that should make you feel something between frustrated and galvanized. According to the Federal Reserve's 2023 survey of consumer finances, the median American household has approximately $87,000 in retirement savings. Not $300,000, $87,000. And here's what's brutal about that number. $87,000 is not nowhere. That's years of contributions. That's real sacrifice. That's actual effort. But $87,000 at 10.5% generates $9,135 per year. Against $12,000 in contributions, your contributions are still outpacing your returns by nearly $3,000 per year. You're still the rocket's primary engine. The atmosphere hasn't thinned yet. The median American household is $213,000 away from escape velocity now. Before anyone in the comments says that's impossible on my income, I hear you. And I want to be honest with you about what this data actually shows, because there's a way to misread it that leads to hopelessness instead of action. The median figure is dragged down by 3 specific groups: people who started too late, people who stopped during downturns, and people who were never given the framework to understand what they were building toward. Almost nobody in that third category, the ones who just didn't have the map, almost nobody stays at $87,000 if they enter under the 100,000 threshold and start moving toward it with intention. Here's what most people don't realize about the timeline. If you're 35 years old and you currently have $87,000 saved, contributing $12,000 per year at 10.5% growth, you reach $300,000 in approximately 8.5 years. You're at escape velocity by age 43 or 44. That is not a fantasy. That is a spreadsheet. If you're 40 with $87,000 and can push your contribution to $15,000 per year, same outcome. Escape velocity by 48 or 49. Still well within a timeline that produces genuine financial freedom, The villain is not your income. The villain is not the market. The villain is the $213,000 gap between where most people sit and where the math changes. And the fact that nobody has ever drawn that gap on a map and shown people exactly what's on the other side. That's what we're doing right now. But there's a second villain, and this one is psychological. The closer you get to $300,000, the longer you've been at this, the more the goalposts tend to move. The lifestyle creep accelerates. The contribution rate stagnates. The person who was investing 15% of their income at $50,000 in their account is often investing 12% at $200,000. Not because they're less disciplined, because the urgency fades. The 50K investor is in survival mode. Every dollar matters, nothing gets wasted. The 200K investor starts to feel comfortable. And comfort is where momentum goes to die. A 2022 Fidelity study found that investors who increased their contribution rate at least once every 3 years were 67% more likely to reach seven-figure balances than those who maintained a flat rate, even controlling for income. The act of increasing your rate compounds just like the money does. Contribution momentum is its own escape velocity mechanism. Part 4, the present day, the magnificent milestone. Let's talk about what the current environment means for the $300,000 journey. Because context matters, and I'm not going to pretend it doesn't. Here's the landscape you're operating in right now. The S&P 500 is currently trading at a Shiller-Cape ratio of approximately 34 to 35 times earnings. The historical average is 17x. I've talked about this before. What this means practically is not that a crash is certain or imminent. Nobody can tell you that with honesty. What it means is that forward returns over the next 10 years are likely to be more modest than the historical 10.5% average. The math of $300,000 escape velocity still works. It just might take slightly longer than the historical baseline suggests. The honest range of S&P 500 forward returns given current valuations is probably somewhere between 6% and 9% annualized over the next decade. Not zero, not negative, but below the 50-year average. And that matters for your timeline. Let's recalculate escape velocity under a more conservative 7% return scenario. At $300,000 earning 7%, your returns generate $21,000 per year against $12,000 in contributions. Your returns still outpace contributions by $9,000. You've still crossed the threshold. The rocket is still above the atmosphere. It's just moving at 7% instead of 10.5%. The threshold holds, the physics hold, the milestone holds. Now here's the present day element that actually works in your favor. And I want you to hold on to this. Interest rates have been elevated since 2022. High yield savings accounts are paying 4.5% for 4%. Treasury bonds are paying 4.3% to 4.7%. For someone in the accumulation phase, grinding toward $300,000, this is a meaningful tailwind that didn't exist for 10 years prior to 2022. Every dollar of your emergency fund sitting in a high yield savings account is earning real money. The cash buffer that protects your investment account from premature liquidation is itself generating returns. The environment that feels threatening because of elevated stock valuations is simultaneously rewarding your cash discipline in ways the last decade never did. This is what I want you to see about the current moment. It's not simply good or bad for wealth builders. It's nuanced. Equity valuations are stretched. Cash yields are real. The honest play is to keep contributing consistently to diversified equity positions while holding adequate cash buffers at these rates, and to set your $300,000 escape velocity target as a North Star that doesn't change regardless of what the market does year to year. One more present day factor worth naming. The labor market, despite everything, remains historically tight. Unemployment as of early 2025 is hovering around 4.1%. That is below the 50-year historical average of approximately 5.7%. In a tight labor market, the ability to increase income through negotiation, through skill development, through changing employers is meaningfully higher than in a slack market. Every dollar of additional income that goes directly to investments accelerates your timeline to $300,000. A $5,000 raise fully captured into investment contributions takes approximately 1.5 years off your escape velocity timeline. That's not a metaphor. That's the actual math. Part 5, the roadmap, how to get to $300,000 with intention. Let me build the map. Because understanding escape velocity is not enough. You need the flight plan. Phase 1, the dense atmosphere, 0 to $100,000. This is the hardest phase. The physics are against you. Your contributions are the primary engine. Your returns are modest in absolute dollar terms. And every market downturn feels like a personal attack. Your job here is survival and habit. Automate your contributions so the decision is made once and executed forever. Increase your contribution rate by 1% every 6 months. You'll barely feel it in your paycheck due to tax advantages, and the compounding effect is enormous over time. Do not check your portfolio during downturns. The account is a flight in progress, not a window you should look out of every time there's turbulence. Target, get to $100,000. The first milestone is more psychological than mathematical, but it's real, And it's where the math first starts to feel like it might do something. Phase 2, the thinning atmosphere, $100 to $200,000. Here's where most people make the mistake I mentioned earlier. The account starts to feel real. The returns start to generate visible numbers. And that visibility can do one of two things. It can motivate you to push harder, or it can make you comfortable enough to coast. Do not coast. This is the phase where contribution rate increases have their highest marginal impact on your escape velocity timeline. A 2% increase in contribution rate during this phase, from say 12% of income to 14%, shaves approximately 14 months off your timeline to $300,000. That's more than a year of your life that you get back. Also in this phase, aggressively optimize the tax side. If you're not maxing your 401(n)(a) pre-tax contributions, you're leaving money on the table that the government is offering you. A household in the 22% tax bracket maxing a $23,000 401(a) contribution is getting $5,060 of government subsidy on that contribution. That's real money that accelerates your timeline for free. Target, get to $200,000 without increasing your lifestyle expenditures proportional to your growing account balance. The account balance is not a signal to spend more. It is a signal that you are approaching the atmosphere's edge. Phase 3, escape velocity approach, $200,000 to $300,000. This is where the math starts to whisper. At $200,000 earning 10%, you're generating $20,000 in returns against $12,000 in contributions. You can feel the shift beginning. Your returns are starting to carry their weight. In this phase, your primary enemy is not the market, it's time. Every year you stay in this phase is a year before the math becomes fully automated. And every dollar of unnecessary lifestyle inflation that reduces your contribution rate extends that year. Here's a specific tactical move that most financial advisors don't emphasize enough. In this phase, every windfall bonus, tax refund, inheritance, side income should be evaluated against one question. Does this windfall deployed as a lump sum into my investment account cut time off my escape velocity timeline? Run the math. A $10,000 bonus invested as a lump sum at $250,000 in the account doesn't just add $10,000. It potentially cuts 6 to 12 months off your timeline to $300,000 depending on market returns. Every month closer to $300,000 is a month closer to the math working for you instead of with you. Target, cross $300,000. This is the mission. Everything else is detail. Phase 4, escape velocity, $300,000, and beyond the rocket is above the atmosphere. The primary work shifts from you to the math. Your job in this phase is to not break the rocket. Do not raid the account. Do not make concentrated bets that introduce catastrophic downside risk. Do not stop contributing. Contributions still matter. They just matter less as a percentage of total growth. And this is important. Do not change the plan just because the plan is working. I have watched people reach $300,000, feel the shift, feel the safety, and immediately make decisions that would have terrified their $50,000 account self. New car, bigger house, lower contribution rate. I've earned it spending. You have earned it. And the way to honor that is to protect the machine that's now working for you. At $300,000, the math will get you to $600,000 in approximately 7 years at 10.5% with continued $12,000 contributions. It gets you to $1,000,000 in approximately 12 years. The compounding from here is not linear, it is accelerating. Every year you protect the machine, the acceleration increases. The rocket is not done, it's just past the hard part. Part 6. The honest take, no hype, no doom. Look, I need to spend a minute being real with you. Because this channel exists to tell you the truth, not to sell you a fantasy. The $300,000 escape velocity framework is mathematically sound. The historical data behind it is real. The psychology of it is documented. This is not a get-rich-quick concept, it's the opposite. It's a get-rich slowly but inevitably concept. But here's what I'm not going to do. I'm not going to pretend that $300,000 is easy to reach for everyone, or that the timeline is the same for everyone, or that the 10.5% historical return is guaranteed going forward. The Schiller Cape at 34x tells us the next decade is likely to deliver below average returns. I've been consistent about this across every video on this channel. Plan for 7% to 8%, not 10.5%. Your timeline extends. Your escape velocity threshold holds. But the map gets slightly longer. Build 3 to 6 months of cash reserves before you aggressively invest. An emergency that forces you to liquidate investments at the wrong moment can set your timeline back by years. Protect the rocket from forced landings. Diversify. The S&P 500 is not the only asset class that works. International developed markets, small cap value, REITs, spreading your investments reduces the damage any single crash can inflict on your compounding timeline. A portfolio that loses 20% in a crash takes 3 years to recover at 10% returns. A portfolio that loses 35% in a crash takes 5 years. Diversification isn't about optimizing upside, it's about protecting your timeline. And be honest about your actual timeline. Reaching $300,000 from zero is not a 5-year project for most people on median income. It's a 15 to 20-year project at typical contribution rates and average returns. That's not discouraging. It means starting at 30 puts you there by 45 to 50 with 15 to 20 more years of compounding before a traditional retirement age. That is a genuinely transformative timeline. But it requires starting and it requires not stopping. The people who get this wrong are not the ones who didn't understand the math. They're the ones who understood it, believed it started, and then stopped at $150,000 when life got expensive or the market got scary. Don't be that person. The atmosphere is already half thinned. Keep burning. Here's what I need you to carry out of this video. $300,000 is not just a financial milestone. It is a physical threshold. In the same way that a rocket either reaches escape velocity or doesn't. Below $300,000, you are the primary engine of your wealth. Above it, compound interest is the primary engine, and you are the co-pilot. That shift is not motivational language, it is math. Calculable, verifiable, historically demonstrated math. It happened for investors in 1982. It happened for investors in 2010. It happened for every person who ever sat on a Sunday morning and realized the market did more work for them that week than their job did. And it will happen for you if you get there and stay there. The Saturn V rocket burned 20 tons of fuel every second at liftoff. Not because that's how much it needed to cruise, because that's how much it needed to break free. You are in the liftoff phase. The burn rate is high, the progress feels slow, and every instinct in your body is going to tell you to question whether this is working. It is working. The atmosphere is thinning. The resistance is weakening. And the same contributions that barely move the needle at $10,000 are going to be acceleration fuel at 200,000 and virtually irrelevant at 500,000 because the math will have taken over completely. $300,000 is not the destination. It's the moment the destination becomes inevitable. Get there. Protect it when you do. And let the math finish what you started. If this video gave you a new way to think about where you're headed, hit the like button. It genuinely helps this channel reach the people who need this. Subscribe to Slime's Wealth Academy if you're not here yet. We do this every single week. No jargon, no gatekeeping, just the real mechanics of how money works and how regular people can use them. Drop a comment right now. Where are you on the escape velocity journey? Just starting, halfway there, already past 300K and here to see it named. Tell me, I read everyone. And if you know someone grinding through the dense atmosphere right now, send them this. Showing someone what they're building toward might be the most valuable thing you do for them this year. I'm Slime Johnson. This is Slime's Wealth Academy. Regular people, real wealth, no gatekeeping. See you in the next one.